Good morning, everybody. I wanted to walk you through some trades. So this morning we talked about this as the knife catch, right? We can't possibly know whether this is the low or not. So I set you up with a reason to get long. We need to show strength. Strength is not green candles. Strength is breaking pre-market resistance in this case. Where do we go if we break pre-market resistance? What we try to do is sweep a high. So you take partials around the local high and then you try to get a runner up to here. That's how you get this long. This is called a knife catch trade, right? And then you have a reclaim trade. A reclaim trade is our first higher low over the 80s. That means we reclaimed our old range. Now, what I'm making here is an idiot's guide to trading. And it's me, the idiot, telling you that you can make money in trading even though you don't know what's going to happen next. And I'm going to describe that to you right now. And do my best to explain it from a mathematical and a mechanical perspective of risk to reward. One, I had the bear case today. The bear case says it comes down to here. Does that mean that this is the low? Absolutely not. I cannot say for this low. That's why I included both of these this morning around 4 a.m. I said it could come down a little bit lower. We don't know. But what I do know is the risk to reward to shorting into a swing low is poor. Now we favor the longs, okay? But that doesn't mean we need to predict this as the low. We can say that we can trigger a long by getting above here, which is something I already covered in the room, okay? So then the question becomes, how do you know if you don't know what's going to happen? You can't predict the future. How do you trade around it? How do you put these little structures on the chart and say that this is going to happen? Well, in truth, they're just party tricks. Here's what I do. I know where all the back tests are, and I know how to trigger them, right? So I don't know that this is going to be the low, but I know that once we clear here, we're likely to retest some highs, okay? That's how I can sideline dangerous parts of the trade, which is right here, where we are figuring out that whether this area is the low or not. We don't know. We don't know if this is just chopping the low right here before a breakdown and a reversal, or this is just actually the low, which is where the bear scenario said that the low would be. We cannot know. Okay? So what we do is instead look for a risk to reward perspective. If you were in a knife catch long, what you would do is you would long and you would sell your first green candle up to the back test of your breakdown. Why do you sell right there? Because 90% of knife catches get retraced. A knife catch, by the way I define it, is testing an untested resistance, right? They're kind of rough trades because your risk to reward is roughly 1-to-1, meaning your stop would be the swing low and you would be playing this untested resistance, but you would expect to retest, which you see here. Flip 50 to 100 charts and you will always see this. Knife catch that reclaims without a retest is called a V-shaped recovery. You never want to bet on those. They are exceedingly rare. Okay, so you know what can get you long again, and you can sideline this entire thing. That way, hey, guess what? You don't need to predict what will happen. I am telling you that this wave structure makes sense, but I'm not telling you to long it. The worst thing you could possibly do is see the charts that I post, but not follow the paragraph of commentary that comes with it, because we don't need to be relentlessly bullish. We just need to know what triggers our trades. For instance, the bear trade was triggered on a breakdown of right here to come to right here and right here. That doesn't mean that I knew last night that this breakdown was going to occur. It just says once that breakdown occurs, where do we go? Most likely right here and right here. Then the next question becomes, how do we contextualize this whole move? Well, we're in a high time frame uptrend and dips are buyable, but that doesn't mean we want to buy them with leverage, right? So we need to set up a new criteria to get long. We need to show strength, so we break through here to start challenging the back tests around here. We expect higher because our high time frames is higher, right? So let's break this trade down in some other ways. But first, before we do, let's like one thing. So our knife catch is a tight, like you're either right or you're wrong. You're right off that support, right? Our reclaim trade is our first higher low off of the 80s. You can be a trader who sidelines all of this drama and sits on your hands all day and plays the Sunday night open if it waits that long, right? And nothing is wrong with that. Let's use some real world examples though. Bitcoin. Bitcoin's going down and everybody's unhappy, right? Well, let's talk about this from a risk to reward perspective. Our Bitcoin entry was 65. We're in from right here. No, even lower. We're in from 65 right down here. This is a trade that I've been tracking publicly. And then we just added yesterday. And where did we add? 71.9. Right. I'm sorry. 79.1. I said that backwards. 79.1 is where we added. All right. From a trade perspective, there is a chance that this goes to zero. I mean, Bitcoin could go to zero. Bitcoin could go to 40. It could go to my target at 115. So the question becomes, okay, if it can go either way, then, you know, what are you doing here? Well, what I'm doing is I bought a swing low with tight risk to reward. I have an upside of a retest, and I'm flipping the coin. I know that heads, I win a 5-to-1 trade. Tails, I lose $1. But here's where it gets a little bit better. What did we do? We trimmed off the first time we made a new high right here, and we protected our stop loss. We got to drag our stop up to the new swing low right here. So no matter what happens in this trade, no matter what happens, you will stop out in profit. You have no more risk in this trade. All you have is upside. So hold on one second. So what you have to do here is you let Jesus take the wheel. You have a stop out, you have an upside, you have a plan. You don't need to do anything, right? Our next set of our plan is as soon as we take this high, we can put our new entry into profit. Now, what will happen is I put my predictions out there publicly, literally all the time. Somebody will show up in my chat and they will be like, you stupid asshole. You said it was going to 115, 125. It just broke down. It went to 30. You don't know anything. Well, that's true, but I'm going to tell you what. They're both stupid and an asshole, and nobody likes a stupid asshole because they don't understand that by the time that this trade stops out, you're already going to be in profit. You will not lose money on this trade. The idea is that we are keeping a tight R and R throughout the entire thing. We buy where we're supposed to. We move the stop loss up when it's appropriate, right? And we keep looking for re-adds on the way to what I believe is the high time frame target, okay? So then the next question becomes, all right, can you keep doing this? You know, yeah, because we're in a high time frame uptrend. Remember, high time frame uptrends are not defined by hopes and feels. High time uptrends are defined by swing lows and breakouts. Our high time frame uptrend is defined as any price action above 7,300, and we should be looking for dip buys above 7,300. This is not a feeling. It's a fact based on the chart and where our breakout occurred from. We cannot lose 7,300 flag breakout, or I'm wrong, and I will no longer be looking for dip buys. In fact, if I was to go bearish, it's going to be a 7,300 loss because that turns this entire trade into a false breakout. I don't think that's going to happen, but you need to understand we don't need to be relentlessly bullish. We just need to listen to the chart and follow, like, it will tell us what to do next, right? So that's kind of where I'm coming from here, guys. And we've done this again and again. I can show you this exact trade setup. The trade setup is always different, but I can show you the same concepts in every single thing. Where was our entry for Oxy? $53, guys, and it gapped up on open. Why? Because we were testing a swing low. I expected a higher low. Why did I expect a higher low? Because I know that I want to take a short entry up here, and the quickest point to get to a short entry is to long quickly, right? So I took a cheeky long to get up to my short, right? Everything is tightly defined. I would have stopped out if this broke. I've already taken profits on the way up. The first time at 55, the second time at 60. I will let the expansion candle finish because I'm not really interested in the upside. Then I'll short it. Like, you understand, you don't need to be right about what's going to happen. You just need to control your exposure and keep flipping that coin. And every time you flip that coin, if you can stay in the game long enough, meaning you don't leverage up at stupid times, you're going to be successful, okay? So please remember, just read the commentary I write, right? So all these charts come with commentary. It's not just like, this is what's going to happen. It's like, if this happens, do this, look for this. Remember that we're in a high time frame uptrend context, right? This is a lot different than me predicting the future, but it ends up looking a lot like predicting the future, because when I draw these like these little wave structures, it's not because I know exactly what the waves are going to look like. I just know where all the back tests are. Like, I know this is a back test. I know that this is going to be the higher low once we clear it, right around here. I know that we have upside to around 7,600, 7,650. Like, I know all these things, right? I know it based on the wave structure. And one last aside before I leave you guys to this, Elliott waves, you see these online all the time. Don't take them seriously when you see them online. I think people use them wrong typically. Elliott waves are not predictive, they're restrictive. What I mean by that, guys, and the reason you always see people change their count is they're just a fancy way to anchor fibs. But what Elliott waves are super good for is Elliott waves, if done correctly, cannot be broken. Price action will not break Elliott wave structure, but it doesn't predict the future. So what I do is I draw out a wave structure where all the back tests are going to be, and then I say that it must match Elliott wave rules. So I'm not using this wave structure to say I know it's going to be a 1, 2, 3, 1 through 5 expansion or an ABC correction. I don't care about any of that. I just need to make sure I'm not violating the rules while I do it. So hopefully that makes sense from a risk to reward perspective. It does not matter if you know what's going to happen. It only matters that you know what's going to do. You're going to preload your ideas of what's going to happen, whether it's going to be a knife catch trade and you know how to sell that, or whether you're looking to play a reclaim trade. You're going to figure that out in advance and you're going to execute already knowing what your risk to reward is. Meaning if we play this all out, you know what your high or low is. You know where your reclaim level is and your risk is, right? You are going to define your trades not as whether you feel good because you see green candles. You're going to define them by levels and whether we're going to move towards those levels or not. And that's going to keep you on the right side of the trade for long. The longer you can stay in the game and set up, those coin flips in your favor, the more money you're going to make, as long as you're setting out correctly, which is what I'm going to try to help you to do. That's about it for today, guys. I will upload a real video later for all the tickers that we follow.